Hello, everybody. My name is Mike Sears. We'd like to welcome you to our 30-minute Thursday. I have with me Seth Morris, who's an advisor in our firm, and we are just delighted to be with each of you today. Seth, welcome. We're just really thrilled to have you with us as always.
Glad to be here, Mike, and welcome everyone who's joining us today. As you know, we are live, so please use the chat function so we can see who's out there and ask questions, comment, ask questions, or give advice for what you think you'd like to hear in subsequent 30-minute Thursdays. But welcome, everyone.
Well, today's topic, I think, is an exciting one, Seth. Those of you who've seen the invitation, we're talking about managing marketing volatility and understanding market corrections. I can't think of anything that would be more important to learn about than that right now. What do you think, Seth?
No, I think that's a good place to be today. Definitely. We do have one slide we have to share first, though, if we could bring that up.
Tell you what, Seth, let's why don't you go ahead and just share the disclaimer for the slide, and then we'll just
All
go
right.
from there.
We love technical difficulties, but yeah, so basically the information we're sharing today is not, it's general information. It's not an offer to sell or solicit to buy a security. We're not giving any specific individual advice. And of course, investing does involve risk, including the loss of principal. And so if you do have questions, please discuss those with your advisor. And there's the slide.
There you go.
Yep. So, Mike, today we're talking about market corrections. We're going to be talking a little bit about bear markets, but I think a good place to start would be to talk just the specifics. What is a correction, Mike?
Well, I think if you mean technically what we're talking about, in fact, I chuckle a little bit when I say this because most people feel that that the market goes down. If the market goes down a few percentages in a day, we think that this is really a correction, but technically it's not. Technically, a market decline between 5 and 9% is a pullback. To be a correction, somewhere between 10 to 19% is called a market correction. And of course, you know that dreaded bear market, if it's a pullback from a recent high of 20%, that would be considered a bear market.
Okay, so just because I'm watching my investments and I see a dip one day doesn't necessarily mean we're experiencing a market correction.
That's correct.
Okay, so Mike, how often do these corrections happen?
Pretty regularly, actually. From World War II going forward, 1945 or so, there have been 26 market corrections.
Okay, so that's an average, of about one correction almost every 3 years, right?
That's
and what
right.
about the bear markets? How often do we see those?
From 1945, we've had roughly 14 bear markets where we've had a drop of 20% or more. That bear market averages about just under every 6 years, 5.8 years. And of course, the most recent bear market that we're familiar with is what occurred due to the COVID-19 pandemic.
Mm-hmm. So we're all familiar with the COVID-19, market correction. We just experienced that. It's fresh on our minds. But Mike, you're a little bit older than I am. You've lived through a few of these bear markets. What are some of the other bear markets we've seen?
I think a number of you may be familiar. Between 2000 and 2002, we had the dot-com crash. That's when we had massive speculative bubble in technology stocks. The NASDAQ was hit particularly hard. It fell about 75% from its high. I think the one that most of us are most familiar with is 2008 to 2009, when we had, remember we had the financial crisis where we had a wave of subprime mortgage lending. The financial crisis spread across the U.S. In 2008, many banks failed. We had massive bailouts. And when it was all done, the market had we had a 50% loss in the market from its previous high. So that was significant. And of course, as I said earlier, in 2020, March of 2020, we had the COVID-19, which actually, due to the economic shutdowns, this was the fastest plunging bear market that we've known of, but also a very, very quick recovery, Seth.
Yeah, no, we saw one of those quick, I think they call it a V-shaped recovery with that market correction there, or that bear market. Now, Mike, when we're in these bear markets, I know it's hard for us to see past them. We're in it, we're dealing with it. But on average, how often do these bear markets last, and what usually happens after?
So let's go ahead and let's do that for a second. I think all of you can probably see this slide. It's a history of U.S. bear and bull markets, and from 1942. And if you look here, you can see that the blue color is the bull markets, and the orange color are the bear markets, right? And you can see that the average bear market lasts about a year, and the average bull market lasts about 4.4 years. And I think it's important for those of you who are watching today is, what do you learn from the slide? Obviously, bear markets, they're occurring. And you can see this first one over here, right? You've got negative 28.5%. You have another one right after it, minus 20. But what do you see in the bull market? Hopefully what you're seeing is that after every bear market, that there has been quite an amazing amount of recovery and growth. At least the history has showed us is that when there has been a bear market, the bull market has come roaring back. And I think that's very significant for all of us.
Yeah, no, as we look at this slide, Mike, there's definitely a pattern here. And I think we can all come to the conclusion that the markets are cyclical, and that, no matter how long or great the bull market is, there will be a bear market. But on the other hand, the bull market will come again. But I think, that leads us to probably a good talking point. We're in these bull markets, we're riding high, the market looks great. Let's talk about some of the triggers, some of the things that cause these market corrections, these bear markets. I think one of the first ones that comes to my mind is profit selling. What can you tell us about profit selling, Mike?
Well, I think an easy way if any of you have invested in, let's just say, a stock portfolio over many, many, many years, and you put a modest amount of money in, and all of a sudden you see that it's grown to this amazing value, you might say, you know what, I've got my profits and I'm going to take it off the table, and it's time to sell it. Well, if we had quite a number of people, we had lots of people realizing their profits after a sustained rise in the stock market, especially what we're seeing right today. And if we had enough stocks trading at a high enough volume, that could actually trigger a correction.
Mm-hmm. And another trigger is corporate earnings. How do corporate earnings trigger market corrections, Mike?
Well, when corporate earnings are projected to rise, usually we see stock prices may follow that. They may increase as well. On the other hand, a drop in earnings, if we did have a drop in earnings, that would prompt the stocks to drop. Although an individual corporation's performance would not necessarily, Seth, affect the marketplace overall. But if we had a downturn in the global economic market, that may affect companies' earnings and their stock prices and prompt a correction as well due to a sell-off perhaps of a certain groups of stocks. That's very possible.
Mm-hmm. And then, in the markets, we also, we're human, so we have the human factor, and fear plays a big role in triggering corrections, doesn't it, Mike?
I think there's no question. And I think, those of you on the call, we are connected. I have a son who's in Germany, and we connect fairly regularly, with the cell phone. We learn instantaneously of things that are happening in the world. So we are really connected economically in a global sense. And so what happens in Mexico affects us. What happens in Jakarta affects us. What happens in China affects us, and we get it in real time. And so if there's a sense of fear based on either negative events or news or perception about the economy. Those are the kind of things, the very things that could trigger a sell-off, and sometimes they do, and that could cause a market correction.
Yeah, no, the market's kind of it's a self-fulfilling prophecy. If enough of us are afraid that it will go down, well, it probably will go down.
Yeah.
Yeah, go ahead.
No, go ahead.
No, I was just going to say the last trigger that we probably want to touch on here before we move on are just black swan events. Black swan events, those are those events that come out of nowhere. They lie outside the realm of what's normal, what's expected. Nothing that we've seen in the past could reasonably point to or predict that they would happen. 9/11 is a black swan event. COVID-19, some people disagree, say maybe it's not a black swan event because pandemics happen. However, in my mind, I think it definitely is. We'll let you, decide for yourselves whether you think that is or not. But that's probably the last trigger we'll touch on today, are just those black swan events.
Okay, very good. And I think, moving forward, I think the big question that's on most people's minds today is, okay, well, this is good. We're learning about corrections. We're learning about bear markets. But the real question is, how do these, volatility in the marketplace, how do these corrections, how do they affect me as an individual investor? How does it affect me in my retirement, the planning of my retirement? I think those are, I think those are very real questions that most people have, Seth.
Yeah, no, we know that these market corrections are going to happen. And I think how we react to them is so important, and that can make all the difference. And, Mike, you've been in this business for quite some time. How have you seen some of your clients react to bear markets or these market corrections in the past?
Well, I think there's two groups. But I do recall, I remember early in my career, I got a phone call to meet with a gentleman who was not my client. I didn't know anything about him. And this was right in the middle of 2008, the 2009, the financial crisis, the subprime mortgages. And he asked if I would come to his house. And so I did. I remember walking into the living room, and he had the television on, and he was watching the news about what was happening in the stock market. And he was absolutely beside himself, Seth. He was frantic. And he kept repeating to me, "Get me out. I don't care what you do. Get me out of the stock market." And, it became very clear to me in minutes after meeting with him that there had been no plan. There had been no strategy. He did not understand the risk that he had taken in his investments. He didn't understand, probably historically at least, that in most cases there have been a recovery. And so he was in a place where he was about to make some decisions that were not in his best interest. And I think that's one of the reasons that we're having this, Seth, why we're even talking about this topic, is to help you who are watching today to not make a decision, a knee-jerk reaction to what's happening in the marketplace that could potentially hurt you. And of course, every individual situation is unique, but that was not a good situation for him. And
yeah, no, it doesn't sound like it. I hope he's in a better place now. But on the flip side, have you experienced or had experience with customers or clients who kind of went through the market correction calmly and they, weathered that storm?
I remember an experience I had, a person who actually did become a client of ours, but I remember he had invested his money quite aggressively. And so this was 4 or 5 years after 2008, 2009 had occurred. And so I asked him, I said, what did you do during 2008 when the market went down? And he said to me, nothing. I said, nothing? I said, why did you do nothing? And he said, I had in fact, he even told me, Seth, he said, I hadn't reviewed any of my statements. I asked him, did he know what his losses were? He said, I had no idea. When he told me he hadn't looked at his statement, I said, why not? And then he said to me something very interesting that I think is worth repeating. He said, I didn't need to look at my statements. He said, I had a very good job. I was making very good money. I could pay all my bills. Yes, the marketplace had taken a dive, but it wasn't affecting my current ability to provide for my family or to pay my bills. And he said, I just decided that this, obviously, if the market continued to go downward, this would affect his future. But he did not make any changes. He did not sell anything. And Seth, over a reasonable period of time, what do you think happened to him as far as his investments were concerned?
Well, based off that graph we saw earlier, I'm sure that it was followed by a great bull market and his investments came back and everything was okay, probably.
And of course, that situation would be unique to every person as to the way they had their money invested. But generally speaking, if we give some things some time, at least the history teaches us that the market has a way of being robust, as we've seen in previous slides. And but that was, he dealt with risk in a very unique, very different way than the first gentleman. Absolutely.
No, yeah, he's kind of outside the norm there. He did the opposite of what we want to do, but what's exactly what we're supposed to do in that situation. And there's actually a slide we'd like to share. It kind of talks about the investor emotions that we feel.
Okay, let's see if I can get that for us. Okay, can you see that okay?
I can. Mm-hmm.
All right, very good.
So, just like your first client you mentioned there, he was concerned about the markets. And if you're concerned about market volatility, the good news is you're normal. Most of us do experience that. But this kind of goes through the psychology of investing. We get into the market, we're optimistic. We start to see some gains in our investments, some returns. We're excited. The returns really start to pile up. And we're pretty euphoric, Mike. We think we're pretty smart. We've got this investment thing down. But then what happens? These bull markets, these runs, they're followed by corrections, and we start to feel anxiety. And we think, okay, this isn't going to last very long. But then if it keeps going down, we get a little bit afraid. We start to think the market's not for us. And then, you can see here in the bottom of this slide, it says the point of maximum financial opportunity. Now, that's maximum opportunity for someone who's maybe not necessarily in the market, or for those of us who have just ridden down that drop. We're pretty scared. There's despondency, there's depression. And, Mike, looking at this chart, when would you say is the time that most people, they tap out? They say, I'm done. Sell my investments. I'm out of here.
Well, obviously, if a person, like the first example I shared earlier, if you are a person where you are feeling the fear, desperation, panic, despondency, you could be very tempted to just simply say, I am totally out. And that would be the worst time to sell off those investments. Now, obviously, none of us know where that bottom is. We don't know where that is. And that also adds to the fear. And but if a person understands, in fact, as we continue on with this presentation, you understand that markets generally will come back. You'll be able to say, okay, I can hang in there. And then, of course, you can see the cycle, Seth, does repeat itself, does it not?
Yeah, it does. And I think, there's a lot of people that get into this this cycle of selling low and buying high, which is the opposite of what we want to do. It's called investor dyslexia.
I think this slide just tells exactly what you just said. It says how not to deal with a scary market. And so when we feel fear, ladies and gentlemen, you notice we're right here. We're saying, I want to sell right here. The market is scary to me. I can't deal with it. I want to get out, and I plan to get back in, but I want to get back in when the market clears up right here where I feel safe, only to be followed by, because markets do what? They do cycle. And so it really teaches us that it's so important to be, as far as timing the market, you would have to be right. If you think that you can time the market, you would have to be right twice perfectly. You would have to know exactly when to get out, and you would have to know exactly when to get back in. This next slide that I'm about to share with you teaches us how difficult that would actually be. So this is the impact of being out of the market, okay? And so we're looking at the returns of the S&P 500 between January 2nd, 2001 and December 31st, 2020. So this first slide says, if we were fully invested, the average annual return, that means we did not sell, the market is cycling, we did not sell, and the average return is 7.47%. But look what happens if we should miss 10 of the very best up days in the market. What happens to the return if I miss 10 of the best days? My return is down over 4%, Seth.
Mm-hmm.
So my return is 3.35%. That's amazing. Now look what happens if I should miss 20 of my best days. The return is 0.69. It's nothing. What happens if I miss 30 of the best days? I'm negative 1.49. Out of 365 days, I miss 30 days, I'm negative. What if I miss the top 40 days? My return is minus 3.4. What if I miss the top 50 days? My return is minus 5. And what if I miss the top 60 days? Minus 6.81. Let's read this statement together. It says 7 of the best 10 days occurred within 2 weeks of the 10 worst days. 7 of the best 10 days in the marketplace occurred within 2 weeks of the 10 worst days. Well, for most people who got out, they would not feel safe. And Seth, do you think it would be even possible to time this properly?
No, I wouldn't try it, and I don't think anybody should.
Let's read the next statement. 6 of the 7 best days occurred after the worst days. 6 of the 7 best days occurred after the worst days. And then finally, the second worst day of 2020, COVID, March 12th, think of this, was immediately followed by the second best day of the year as of this writing. That's amazing. So ladies and gentlemen, when we think about timing the market, who could time this? Who could figure this out? I think it would be very, very difficult for most anyone to be able to determine what those best days would be. And so what this slide is trying to teach us is the importance of staying fully invested during that period of time. Now, of course, Seth, I mean, there could be situations where there could be situations where actually where maybe there could be a change. There could be someone that had an immediate cash need, no matter what was going on. And by the way, that's what makes it really a struggle. Imagine if all of your assets, Seth, were in the marketplace, the market goes down, but you're using that money for income. And I mean, if there was ever a time that we needed a safety net to stop taking withdrawals out of the market that is down, that might prompt a change in our withdrawal schedule somewhat. But most of the time, assuming that we have the risk profile correct, and the financial plan is in place, there wouldn't be a lot of changes, or probably usually would not be a lot of changes.
Yeah, no, I mean, so obviously we want to get these best days. We'd like to avoid the bad days, but they come when they come, and it's hard to avoid them. What pieces of advice would you give to someone, other pieces of advice, when market volatility comes, Mike?
Well, I think the first one is be patient. Hearing that the markets are down should not send you into a panic. Of course, again, as in the example that I gave of the first gentleman that I met, we'll panic. Knowledge is power. And the more we're equipped, which is why, we're trying to do this, the better your education is as to how markets work. Hopefully when you've met with your advisor, and those of you who are our clients know that we've taken quite a lot of steps to make certain that you understood what the market risk And there's a range depending upon the risk that you're willing to take, but it's known. And it's not perfect, but that helps us hang in there when things get ugly. And frankly, things do get ugly sometimes. It's just the nature of it. So I would say be patient. I think secondly, don't overthink it. In times of trouble, you might be tempted to go to some investment magazine or some investment guru that says this is the hot mutual fund or the hot stock that we should invest our money in. And that rarely works, by the way. What we end up doing is we end up chasing the hot investment, which we may have heard is recently at the top of the marketplace, only to find out that the next year it's at the bottom. And so we can't believe that we're wrong. How could it be at the bottom? Everyone said, Seth, that it was good. So we hang in there only to find out that we're in the same position. And finally, when we can't take it anymore, we think, well, I guess I really do need to get out. And you get out only to find out that that same very investment that was at the top that went to the bottom is starting to move its way back up. And so so that really leads us to this next position to be in times of market volatility, and that is to be fully diversified. A fully diversified portfolio, fully, in all the asset classes. That includes safe assets and all the various stock components, bonds, all of that. A fully diversified portfolio will weather a storm better than having individual investments where you're not fully diversified.
Mm-hmm. Well, I think the diversification, we plan for that a lot. And, in our next 30-minute Thursday, we're going to be talking about, what is a financial plan? And those plans, they do include, assessing your risk and your tolerance for risk. What are you comfortable losing? Because, Mike, as you know, most of us are much more concerned with what we're going to lose than what we're going to get. And so those are other ways we need to assess our risk. We need to know our tolerance in advance. We need to diversify our portfolio. We need to have different investment vehicles so that, like you said, if there's someone who does need income from these investments when the markets are down, well, maybe they can turn off that income and they have a safety valve somewhere else that they can turn on until the market does, recorrect and we're in a positive position. And so we are going to talk about that, financial planning, kind of 101. What is a financial plan? That'll be on Thursday, the 29th at 4:30.
Let's see here. I think I got a new date, by the way. It was just handed to me. I think it's, let me just check here. Is it is it August 5th or is it another day? Okay. All right, Seth. Looks like the team just gave us a new date, everybody. The next time we're together is August 5th at 4:30 p.m. And our topic is going to be, what is a financial plan? And what else, Seth? Is there anything else before we announce our Box of C's candy raffle winner? Anything else on your mind?
I mean, we could probably talk about market corrections, for hours or days. And, everyone's situation is different. I think if you are concerned at all about market volatility, or maybe you're watching this and you're thinking, okay, are my markets or my investments where they should be? Am I invested appropriately for my risk tolerance? Those are all good questions to have. And you should, speak to your advisor or to us. If we are your advisor, we'd love to be able to have that discussion with you in more detail.
Okay. I agree with you totally. Well, the raffle winner is Kylene Wong. Kylene, we're just delighted. Our team will be in contact with you, and you'll receive a box of C's candy. I hope you and your family enjoys that. By the way, we've been doing this now, I don't know, is this our fourth time, something like that? And we hope that the information that we're providing to you is of interest to you and is helpful to you. Please feel free, if there's a specific topic that you would like to hear in more detail, contact Lisa, and we'll talk about it as a team, and we'll put it on the calendar somewhere, and eventually we'll be talking about some of your favorite things. So signing off today from Rancho Cucamonga, California. We're just delighted to be with each of you. Thank you for the wonderful people that you are. I know many of you, as I've seen, I'm looking at the chats here. Many of you I know and appreciate so very much. So we're delighted to be with you. Please have a wonderful and blessed day. Thank you again.